Good afternoon, ladies and gentlemen. I hope you all had a good lunch. My warm welcome to the this public seminars organized by the Center for Financial Econometrics at the Sippel Institute for Financial Economics at SMU. My name is Jun Yu. I am the director of the institute, and together with Professor Peter Phillips, I also co-direct the Center for Financial Econometrics. The Center for Financial Econometrics was founded in the middle of 2008, so more than 3 years ago. Since the beginning, the center has tried very hard to be a leading research center globally for research in financial econometrics, with strong practical applications and international links. Due to the effort made by researchers affiliated with the Center for Financial Econometrics, SMU has been ranked among the best 5 universities for research, for academic research in econometrics, according to the leading journal publications in econometrics. We are very proud with this achievement, which we are confident that this record has helped us to build international credibility. However, we like to move to the next phase of the development. We would like to build up international links and find interesting and important practical applications for econometric techniques. And today I'm very pleased to introduce to you a leading practitioner and a front runner for index building, Mr. Konrad Sippel from STOXX. STOXX is an established index specialist of European origins. Since 1998, STOXX has come up with many innovative indices and now is operating globally on all asset classes. And Konrad is head of the global product development at STOXX. He is responsible for the development of innovative new index concept, as well as the index business of the existing indices of STOXX, Deutsche Börse AG and Sixth Swiss Exchange AG. He has spent the last decade in the index business, primarily as an index developer at Deutsche Börse AG. In the period, he was involved in the creation and the design of hundreds of indices. Some of the indices he has created has been widely used in Europe. So ladies and gentlemen, please welcome Mr. Konrad Sippel.
So thank you very much for the kind introduction. And I would like to thank you especially and the SMU in general for having me here and giving me the opportunity to speak to all of you. So this is the moment where normally when I give a talk to, like say, investment professionals or media, I tend to say that, don't worry, I'm a mathematician, but I'm not going to talk about numbers. But as you guys are all very familiar with numbers and very sort of sophisticated, I'm a bit worried that my talk may be a little too unmathematical for you. So if that has the case, please do ask me questions afterwards. I'm very, very happy to actually go into more detail on the concepts that I'm showing here. So what I'm going to do here in hopefully roughly the next 40 or 50 minutes is 3 things. I'll give you a very brief introduction on what STOXX is, sort of a little more detail on what you've already heard. And then I'm going to go into the actual topic of the talk, which is talking about giving you my view on how I've seen the world of indices evolutionize and how it's probably going to continue to evolutionize. I'm going to show some examples and techniques, and some of the idea of the second part of this talk is to actually show you, using live examples, how an index provider works, or how product development within an index provider works, while actually touching on the topic of evolution as well. And finally, and this is maybe the most interesting part, I'm going to talk about some of the most advanced concepts that we're currently seeing used predominantly in Europe, and we're currently in the process of bringing to our clients here in Asia as well. So, STOXX Limited was founded in 1998 on the verge of the introduction of the euro in the Eurozone, in a unique historic opportunity that faced itself by showing by creating a unique currency, or a joint currency across the European countries. There was a unique opportunity to create an index utilizing that opportunity, and this was actually the time when the electronic trading of derivatives started to evolve in Europe, on Eurex specifically. So this product was the right product at the right time and is immensely successful. I'll show some numbers in a second, and forms the current basis for the success of STOXX. Now, we actually are owned by the two exchanges in Frankfurt and Zurich, the Deutsche Börse Group and the Swiss SIX Exchange. But we are evolving from this European basis that we used to have into a global provider. So for about the first 11 years of STOXX's existence, we were limited to operating in Europe only by our previous shareholder structure. And since early 2010, we've actually been able to really expand our operations globally. So actually the CV I submitted here isn't quite correct, because since February, we've actually launched about 2,000 additional indices. So it should read, I was involved in the creation of thousands of indices rather than hundreds, simply for the reason that we actually added some stuff this year. Now, thousands of indices, why thousands of indices, you may ask? And the point is, ultimately you need to start. In order to be innovative, you need a basis, and that basis is a set of standard indices for the world, and I'll talk about that in a second. So we're global in terms of the product range. We're also starting to build up local presence here, so we have some people based in Hong Kong, some people based in in Tokyo, and we're also looking for people to be based here in Singapore as well. We actually also market the DAX and SMI indices, which you may be familiar with for Switzerland and Germany. But what I really want to talk about is the last point, and that's the innovation. Now, we've been stuck in the European frame of being able to provide only European equity indices for about 11 years. At the same time, we had a desire to grow our business and to come up with new ideas and help the investment community. Now, we couldn't expand geographically, so we had to expand methodologically. So we actually became and this is actually on the next page, we became an innovator in that European index space by creating a lot of concepts that may be very common knowledge to you today, first, because we just had that need to innovate. So we actually introduced the concept of free float weighting, or free float market cap weighting for an index, which you would today consider as totally standard. Certainly wasn't standard in 2001 when this was first introduced by STOXX, and every other provider followed suit quite quickly. We also pioneered the ETF market in Europe. The first couple of ETFs that were listed in Europe for the first few years were exclusively based on STOXX indices, and we worked very hard on bringing that market forward into the leading position that it is in now. But we also started to build strategy indices. So we actually were the first to bring out dividend strategy indices, for example, using or putting more weight into dividend stocks, or selecting stocks by their dividend yield rather than by their market cap only. And we built things like futures-based indices, options-based indices, and all sorts of crazy ideas that have been very successful in the European market and may at some point also become relevant for the Asian markets. I won't bore you with the market position too much, but in Asia it's often important to mention that we are actually one of the leading global index providers, because our name is not so well known here. Our heritage is from Europe, and that's where most of our volume and assets is today. But if you look at the big picture, behind MSCI and S&P, we're actually the third largest equity index provider globally, and much larger in terms of assets under management or derivatives trading volumes than players like Dow Jones or Russell. So we are actually, with our operation, one of the global providers who's now taking our business to Asia. Similar story for the derivatives markets and structured products markets. The structured product market, maybe if this is of some interest to you, is somewhat special because it is just so dominant in Germany. And in Germany, on the DAX alone, you will find over 100,000 structured products are issued every year. And that number is steadily growing. Now, those are sort of knockout certificates. Many of these certificates actually live for less than 5 minutes on the market because they hit some sort of barrier and they already disappear. So this is an ode to the German sophistication when investing in financial products. So the German retail investors actually do use some pretty fancy structures on indices. So it's pure plain vanilla index performance doesn't seem to be enough. So there's a lot of appetite here for these types of products, which you see reflected in the fact that it's primarily the local German market product DAX that has these high volumes. But let's talk about index development, and that's sort of my part in STOXX. So I just previously mentioned it as a basis. In order to start developing indices, you need a core set of countries or securities that you cover. So, and this is nothing different from any other index provider that you're going to talk to. Everybody needs a base universe. So we call this the total market index. So our STOXX total market index covers, was it say 53 countries worldwide, all the major ones all the relevant stock exchanges from frontier, emerging, or developed markets. We split that in a number of sub-regions, and really the number of sub-regions is not really limited. So if we do find investors who want to look at a specific combination of countries, that's easily done. So this is just an extract of what can be done. And then you run a whole range of indices on that, usually starting with the total market index, and you have a broad index that covers less components, but still similar, still a lot of the market cap. Then there's a blue chip index for trading and sector, style, size. So and this is how thousands of indices come about pretty quickly. If you take every country and stick sectors on it, for example, then you already have a 53 times 18 number of indices. And then we haven't even talked about total return, net return, gross return, and all sorts of other indices. Now, the second part, and I'm going to talk about that later, so I'm not going to cover it here in extensive, is then that you use that broad set of thousands of indices and a set of, and this is just some examples here, and a set of quantitative strategies that can be used as an overlay to those countries or markets or sectors to create some sort of strategic or quantitative alpha on top of the standard market index, which represents the beta. But let's talk about evolution of indexing. And one thing I just want to mention here, this is the part about how do we actually work. I'm going to show a number of indices in this presentation that don't actually exist in that sense. So they're not out on the Bloomberg ticker. They've just been created using a tool that we use internally that we call Index Factory, which we use more or less to try out ideas, to just throw together a few markets, look at the performance that comes out, and actually adapt that. So we use here our global coverage, our data that we have, and we can really combine this freely with different strategies. And what I often try and tell people is that we could create millions of indices. I could extend my CV easily by saying that I created millions of indices, because all those different combinations and mutilations of different concepts would lead to that. But in order not to overload the world with indices, we tend to work on a more demand-driven basis. So we actually do go out and tell investors the methodologies, and then we determine jointly with that investor which market we should be applying this to. So therefore, we need this sort of Index Factory tool to quickly test the ideas. And this is what I've done. So whenever it says STOXX in front of an index, then it actually already exists. If it doesn't say STOXX in front of an index, then I've just made it up using our Index Factory tool. Now, the evolution of indexing and I'll elaborate a little bit on this, is that most of the time initially in a market where investors are warming up to the idea of using index-based investments, it's a very local market view. So today and also the last week I've been traveling through various cities here in Asia, and every time I've heard this, well, we're looking at the local market index only really predominantly. So here in Singapore it would be the STI, in Hong Kong the Hang Seng, for example, or the Kospi in Seoul. And that's sort of the normal evolution to look at your local country. And an evolution in a different way is that actually when you look back at when indexing started, sometime when someone in New York had the great idea of writing down 30 stocks prices on a whiteboard, drawing a line under it, adding it all up and dividing it back by 30, which is the birth of the Dow Jones Industrial Average, of course, that was meant as an aggregator of information in a time when the internet or Blackberries or real-time information systems were really not even imaginable. People needed some form of understanding quickly on how's the market moving. And it's no surprise that many of those long existing indexes that are very, very popular, very well known, actually stem from publishing houses or have newspaper origins, like also the STI, of course, here in Singapore. But the evolution quickly moved on to actually provide a more focused product that is actually used for derivatives trading. In some cases, those newspaper-based products were adapted and were actually turned into that derivatives underlying. In other cases, other indices actually emerged, such as the S&P 500 in the US, which really on a sort of global scale in terms of derivatives volumes and assets has outrun the Dow Jones Industrial Average by far over the past 10 or 15 years. Now I'm going to look also at a more regional approach as investors look for different sort of return patterns and more diversified portfolios. You're naturally going to look at regional or cross-regional indices and add additional markets where you feel you can invest in those markets and that there's an added benefit. And I'll look extensively into that. And finally, when we go to the last step, and this is where the number of indices that is going to be put out is going to explode, because you're going to have very individual requirements in terms of demand, in terms of enhanced indexing. And I'll be looking primarily at two ways of measuring the result of a strategy index here, and that's risk and return, and the position of the index on that risk and return space. I'll actually plot everything that we do on that in a second. So, if we start for the Asian region, and now the typical view, especially from the Western world, on what is Asia has been developed by, or has been dominated by the developed markets, Japan, Singapore, and Hong Kong. Now, you could start with a broad market index for these countries, and I've used the STOXX indices because it's been easier for me, but you could of course also here place the respective local indices, and the performance won't be that different, and I'm sure you're much more familiar with these numbers than I am, for example. But I want to point you to the numbers at the bottom. So the ADTV, the second from the bottom, is what we call average daily turnover. So this is a 3-month average on how much volume is traded during the day. When we're looking at actually having an index that goes from this sort of pure market measure and information product into the underlying for a derivative or an ETF or an actual tradable product, the trading cost and the cost associated with replicating that index become a major factor. So therefore, if you have very little, and if you look at the Singapore, the average daily turnover, and I believe this is in million US dollar, that's right, there's actually a very, very small amount of turnover if you take the average across the entire market. Now, if you were to replicate this, and you were to stick, let's say, 100 million US dollar into this product, you'd have to actually trade quite a significant amount of the daily trading volume of some of the stocks, which would mean you'd have market impact cost. Therefore, actually, they wouldn't probably be able to replicate the performance of the index in that way because the market impact would drive the performance down. So the next step in terms of evolution is, of course, to stick a blue chip index on top. The blue chip index shouldn't ideally change the market performance too much. The idea is you use much less stocks, but you're still more or less replicating the market. But at the same time, you're massively increasing the daily turnover. So if you look at this, with the exception of Japan, which has actually quite relatively strong large cap effect, and I'll need to apologize, the two charts are the wrong way around. So the top one is the blue chip and the bottom one is the TMI, as you can see from the numbers below. But what is really important to look at is the average daily trading volume and the market cap compared to the total market index. You have a massive increase in the average size of the company, so you're owning less in terms of percentage of the companies when you actually replicate with a large fund, and you also have much less market impact if you actually trade in that specific market. Now, that's all fine, but STOXX is probably not going to be particularly successful with local indices for any of these markets. So in product development terms, we need to think further. So we're going to go one step further in the evolution and look at cross-Asia indices. Now, this is the first index that we've just made up. This is the combination of the previous three markets, Singapore, Japan, and Hong Kong. And just thrown together, looked back at the history over 10 years using a standard free float market cap weighting methodology. And ultimately, if you look at the numbers, there isn't all that much hype about Asia here. There's no large performance benefit. In fact, the performance is lower than for a global developed market index, and the volatility is higher, representing a higher risk level. So from that sort of perspective, the fancy Asia story that many investors have been going with hasn't really held true over 10 years if you just look at developed markets. Now we'll see why that is in a second, and this is the risk-return matrix that I promised to show you earlier. Now I need to apologize, I forgot to put the labels on the graph, so I'll just let you know that the risk is on the bottom axis and the return is on the top axis. And so ultimately, and I don't need to tell this to any of you, but the sun shines in the top left. So this is where you want to be, right? High returns, low risk. And if we now look at these three local markets and put the developed market index in there, then we haven't really progressed very far towards the sun. And in many ways, coming off Singapore and Hong Kong, we probably made a step backward. And that's obviously because this index is dominated by Japan. Now, the Japanese stocks have a large market cap, so they dominate strongly this portfolio. So the green dot of the joint index is pretty close to the Japanese dot and not particularly exciting. So from an index development point of view, also from an evolution point of view, we'll start thinking, how can we make this Asia investment a little more interesting? And one story springs to mind, which is Korea. Now, the green index would be a standalone Korea index using 20 stocks, which has had a bombastic performance over this 10-year period. So clearly, adding this to our index will change the return for the better. But even though the Korean index itself is actually quite a risky and volatile one, in the overall correlation or the portfolio analysis point of view, the actual correlation with the other developed markets is pretty low, so we actually have a benefit on the risk diversification side. So we can add 3.2% performance and lose 1.1% in risk just by adding 20 Korean stocks. Now, you see that the charts at the bottom aren't actually that different. So the weight of the Korean stocks compared to the Japanese, Singaporean, and Hong Kong stocks that we have in there is relatively low. We could of course now go in and change the index methodology, put more weight to the Korean companies, add more Korean companies, do all sorts of things to move that performance chart up. But the point here is really simply by adding those 20 stocks at a relatively low weight, we can significantly change the risk-return profile of our Asia investment. And it says here 1 of 4, so there'll be 4 more. We could go on forever, but I do understand that you have other things to do, so we'll just look at the 4 and then move on to another topic. But what about adding Malaysia? So I'm now. And you need to bear with me. Now the DMAI plus SK plus Malaysia is kind of the previous index plus Malaysia on top. So now we're adding 20 Malaysian stocks and we look at what happens. Now what does happen is actually and this I'm still comparing it to the developed market index. So we only gained 0.1% in terms of performance, but we have actually managed to reduce the risk further to 22.1%. So we are actually down a little bit on the risk side. But if we think about Malaysia being a market that probably for many investors it's more difficult to trade. Many Western investors or global investors may have difficulty accessing that market. The added benefit of adding Malaysia to our index is probably not so high. But we'll go with it anyway and add the Philippines. Now we're looking at another market that has had a good performance, better performance than our developed market index for very small companies. So using our market cap weighting, we're adding a little bit of performance, but it doesn't actually change our portfolio all that much. The risk actually stays exactly the same. And finally, before I close this little part of the session, we probably also need to talk about China. So China A shares haven't actually performed that well in terms of putting them together in an index over the past 10 years. There's been a huge peak, but also a significant drawback afterwards. And in terms of our index here, the performance remains in the same sort of area, about 8.3%. But adding China actually reduces the risk again by another 0.5 percentage point. So there's a bit of correlation benefit added from to be gained from adding China. Now, the point I'm trying to make here is that you can construct indices more or less in any way that you like. You need to really understand what is the market that I want to follow, what is the risk-return profile that I aim for. And our role in the investment community currently is pretty much one of actually sticking as many dots onto this risk-return profile as possible, because we will find investors who have specific risk levels they don't want to breach. We will find investors who will want to look at certain elements of return, don't want to be content with just developed markets returns, specifically when also looking at regions like Europe, which is very developed but also very unattractive in terms of return expectations. And one thing that we do with our clients, and that is also an offer that I'm very happy to extend to all of you in the room here, is we actually work together on finding ideas that could work as an index, and we're using the capabilities that we have in-house to look at whether those ideas actually work. So if we just assess what we've just done in the last 10 minutes in terms of adding various emerging markets to our developed market Asia index, we've actually moved closer to the sun. Probably not as close as I moved to the sun over the weekend, but still we're getting there. And so probably one of the important takeaways at this point here is to say that the allocation of markets that you're choosing when looking at a region is of predominant importance. It's going to affect the risk and return profile of your investment significantly more than some other choices, like choices of which product type to use, or whether the management fee on the fund is too high or too low. And the first thing to understand, specifically when looking at a Pan-Asia fund, for example, is which countries does it include? What's the weighting methodology? Do I understand how it's put together, and what effect that has on the return? So you need, or we need, standardized frameworks to actually generate those individual strategies and ideas. And with Asia and the fragmented markets that we see here, and the sort of different regulatory environments with investors having difficulty accessing markets, but every investor having a different difficulty accessing different markets, I believe strongly that we will see a number of indices for Asia, and not just the one index that is going to be the main proxy for Asia. There will be a number of indices, and they will be very individually tailored to what investors require. But we're not finished yet, so I still have about 16 minutes left. So let's move on and talk about the next level, or enhanced indexing on top of that. And again, my group in STOXX is 80% of our time we spend on trying to come up with new innovative ideas. And therefore, this list here is absolutely not exhaustive. It's just 4 examples that I would like to run by you. And we have a bunch of others that we're currently looking at, that we're developing, that we're speaking to the market about. And if there's any interest in sort of hearing about more, I'm happy to add a few ideas at the end as well. But let's talk about those four here. So two of those four actually already exist. The other two are currently just a concept that we've looked at. And the first thing I want to talk about is we call risk control. Now this has actually emerged from speaking to pension funds and large institutional asset owners who felt that they wanted to maintain exposure to equity markets, but not at all costs, or not at every risk level. And they were looking for a passive benchmark that would actually maintain a long investment in their underlying index, while at the same time keeping the volatility at a more or less constant level. And we offer this, and you could offer it for 17.3% or pi% if you wanted to. And we'll stick to fives and even numbers, so we actually offer this for 5%, 10%, 15%, and 20%. But we do speak to people about individualizing this too. What does it do? It's actually very, very simple. We'll look at implied volatility if we can measure it, if not at actually observed historical volatility. And if the market volatility exceeds our target, we'll just deleverage the index investment and put some more money into cash in order to bring the volatility down. At the same time, if the volatility is much lower than the observed than the desired target volatility, we can use leverage to actually increase the volatility to that desired level. This obviously leads to the fact that if you have high volatility, the index will be very low equity exposure. And if you look at the chart in 2008, when the volatility shot up to the roof as part of the Lehman crisis, this index concept actually went into a relatively passive state and de-invested from the equity market, therefore not taking that full hit. Whereas at the early part of this chart, starting from 2002, for a couple of years, market volatility has actually been roughly around the desired target volatility level, so there's not a huge difference between the two strategies. Typically, this strategy outperforms in phases when you have a low volatility bull market, where with relatively low changes in the market, there's an overall bullish trend, and it outperforms very well if there's a high volatility crash. And one thing that's important to understand about strategies, and this is going to be highlighted on the next one, which is the optimal leverage strategy, is that unfortunately, strategies don't always work. So whatever strategy you follow, it is designed to work in a specific market environment. It's designed to deliver a specific purpose. It will not necessarily deliver returns or better returns than the underlying index at all times. This is my favorite saying here, is that if I found a way of generating a strategy that always outperforms in all market conditions always, then I'm afraid I wouldn't be standing here. I'd be sitting on my own Caribbean island and having a cocktail. So we need to understand that strategies can also fail, which doesn't necessarily make the strategy a bad strategy. Strategy indices or enhanced indexing are not a substitution of standard indices. They are an addition to a toolkit of standard indices. So a investor that has a large choice of these strategy indices can use the strategy indices to replicate or to invest in some of his market views, or to actually implement his market views in the best possible way. Now, the optimal leverage strategy that we have built with extreme success in Europe, where it works very well, has quite frankly not worked in the past 10 years in Asia. And there's a large temptation from my side, of course, to just cut the time period to such a way that it does work, because there is obviously periods in it works. But I don't think that would be the point or benefit of this talk here. So this talk is about giving you the picture without the makeup, I guess. So the picture without the makeup in terms of optimal leverage simply didn't work over the past 10 years in Asia. Now you can go in and try and analyze why that is the case. Optimal leverage is a strategy that uses, it's based on a paper that one of our senior researchers has written a couple of years back about determining a factor using implied volatility, historical volatility, and historical performance that gives a best guess at with what leverage factor should you be invested in the market at any given time. Now this leverage factor theoretically should actually pick up on low volatility bull markets and go in with a high leverage, but the way the quantitative numbers have worked here, it simply hasn't worked, except for one way. The concept has overall identified low leverage or deleverage as the optimal strategy, which has ultimately led to a reduction in overall volatility from 25% to 20%. And I'll show you this on the graph in a second, how it comes out. But I think the important takeaway is that don't buy into the we have a strategy that always works kind of marketing. Ultimately, the best way a strategy can be explained to you is that this is a strategy that usually works in this type of market. And then it's down to you to decide whether you feel that we have this type of market and whether that strategy is the right one for you. Equal weighting is another concept, and I understand that there's also extensive research going on here at SMU in this regard. So equal weighting has, or let's just say alternative weighting methods have gathered a lot of interest in, specifically in the US, with the FTSE RAFI indices and the fundamental index weighting gaining some attention, primarily because of shortcomings of market cap weighting, right? So the most drastic shortcoming of market cap weighting is that you tend to invest most of your cash into those components that have actually recently received the most, or that are the largest and therefore have the most potential for price losses as well. Also, market cap weighted indices sometimes suffer from the fact that in a typical market cap weighted index, you have about 80% of the weight associated with the top third of the components, and the bottom third or the bottom 2/3 of the components of the index don't actually contribute a whole amount to the index. And with equal weighting that changes, of course. If you equal weight, the bottom third weighs a third, the middle third weighs a third, and the top third weighs a third. So ultimately it's an exploitation of a small cap effect versus a blue chip effect. And with the Asian data that we have here, the data is somewhat inconclusive. There's a relatively long period where it works. There's a relatively long period where it doesn't work. And therefore, this is not, again, not a strategy that is necessarily working at all times, but if you do have a market opinion on saying that we do think that those blue chip companies, those top 1/3 companies, tend to be overvalued and there's a more growth potential in the small caps or the mid caps, then an equal weighted strategy is actually a very, very simple and easy way to follow through on implementing that market view with success. Now, let's look one last time at the risk-return matrix for a second. And unfortunately, the equal weighted data is for different time frames, so therefore it doesn't really fit well in here, so I've left it out. But let's look at the optimal leverage and the risk control here. And again, in terms of coming closer to the sun, at least the risk control topic has worked very, very well over the past 10 years. And the Asia 100 optimal leverage has at least reduced our volatilities on a risk-adjusted basis. That strategy hasn't actually been as bad as it may originally look from the previous chart. So let's and ultimately this is a very small part of the risk return matrix that I'm showing here. But what we're seeing is that we're putting, as part of our strategy index efforts, putting more and more dots onto this risk return matrix. And obviously the ultimate dot is to place one right at the front, the efficient frontier, which is the minimum variance concepts, which is one of the things that we've done in the past, but there's some issues with that, right? In order to properly use a Markowitz model on an index portfolio, you need return estimates. Now, of forecasts. And we don't actually engage in any forecasting. We are an index provider. We measure markets. We're very fact-based. The sort of forecasting is down to our clients to do. And therefore, we struggle, of course, with putting proper return forecasts in there. So the original attempt that we made, and this was actually also heavily supported by academic research, is that we just said, well, let's just take historical returns as a proxy for future returns, which, of course, everybody says you should never do. But if you try it, and you also use historical risk as a measure for future risk, you do actually generate a much more efficient portfolio. You don't generate the efficient portfolio, you generate a much more efficient portfolio than, for example, if you just take the market cap weighted portfolio. Now the development is not stopping in this area. So what we're currently doing is we're working with an external party to look at actually putting a factor model in place that will allow us to come up with better return estimates. And we're also looking at implied volatility measures rather than observed volatility measures to get a better estimate on how risk is going to change. And so those dots are going to be moved closer and closer to the efficient frontier. There's also going to be other dots that have certain absolute return levels and other dots that have absolute risk levels. And so this picture is going to be filled, and ultimately, depending on what your return expectation for a specific market is, you can just pick the right dot for that specific return expectation. That's ultimately the business that we are in. And finally, I'm going to take a couple of minutes to highlight something completely different and something that I'm not going to plot on a risk-return basis, which is the sustainability aspect of investing. So ultimately, we're moving away from market risk and market volatility to a more less measurable form, which is social risk or reputational risks as well. So about a year and a half ago, we started speaking to asset managers about building a sustainable index or sustainability index. And one of the big trends or the big mega trends that I see globally is the trend towards more sustainable investments. If you just look at the numbers of signatories to the UNPRI initiative, which more or less means that an asset manager signs the UNPRI initiative and commits to investing their assets sustainably. More and more asset managers are asking, how can I actually do that? Now, the previous knowledge or the previous truth to that question has been, you go to a third party who will tell you if a company is sustainable or not. Now, that's worked for quite some time, but now we're actually seeing investors out there who say, well, actually, we want to know exactly how sustainable is defined. What does sustainable actually mean? I mean, how much does it count to have high CO2 emissions? How is that put in relation to the fatalities at the workplace, for example, which is more of a social factor? And those investors are actually running very sophisticated screenings of companies themselves, where they imply their own definition of sustainability in order to determine which companies to pick. And there wasn't an index solution out there that was actually supporting this. So what we created is an open standard of 128 factors that are more or less relevant to the sustainable development of a company. And for example, the CO2 emissions could be one of those in the environmental area. Fatalities at the workplace could be another one in the social area, for example. So we put this together. We actually, and this is the key part, we make it transparent. You can actually download from our website the full catalog of criteria plus their weightings, so that we can tell you exactly that we will put a specific weight to a specific factor. So we can say we put a weight of 17.3% of the social rating to the factor of death at the workplace. And we do that sector by sector, and we actually run this across 1,800 companies globally, including 600 companies from Asia, and a large number also from Singapore. And we then again we publish those scores on our website. So it's nothing secret. It's actually we intend to start a dialogue with the companies to actually come up with the right and consensus measurement for sustainability. And we customize this model. So if we find a client who tells us fatalities at the workplace cannot be 17.3%, it's going to be 30. Then we'll discuss with that client about reducing some other weights, because you do have to add up to 100 in the end, unfortunately. And actually build a separate index for that client that actually replicates that person's sustainability views. And we actually intend to, and this is something that we hope to bring to the derivatives markets very soon, to bring 4 indices to the derivatives markets. And that's another sort of level of innovation. First of all, a broad overall ESG index, but also an index for environmental, one for social, one for governance, constructed in such a way that they run as a so-called roll-up, so you can kind of trade them against each other. So if your view, and that's the view at least of many people that I know in Europe, is that ESG or sustainability is primarily green investing, that environmental is probably 80% of that, whereas the rest is only 10% and we probably don't even care about it. You can actually implement that very own strategy using those derivatives by just buying the broad index and then over or underweighing specific sub-indices using the derivatives that are going to be on offer. And I don't have any numbers here because I don't like to talk about numbers, specifically performance numbers when we talk about ESG. People do look at sustainable indices and say, oh, well, they underperformed this year, that's not working, there's no effect of sustainability, and so on. We do need to bear in mind that a company that acts sustainable has usually a long-term plan of reaping the benefits of this sustainable investment. So I'm happy to talk about numbers in like 5 or 10 years when the level of disclosure that we have today and that we haven't had for a very long time has been there for a while. This has become part of financial analysis. Then we need to really be able to demonstrate that these type of indices really do outperform a normal market cap benchmark. But it's wrong and counterproductive to actually look at a sustainability index today and start making an investment decision based on an outperformance over the past month or 3 months. That's just not the way to properly look at these indices. They will need to deliver, but that delivery will probably be in a 5 or 10 year time frame. And I'm just including this in here because it is, in our view, one of the main initiatives that is going to drive investment in asset management markets over the next years. There's a lot of data out there that suggests that most of the mandates that are today being given out to asset managers are actually do contain some form of sustainability screening. In the lowest case, that's something like screening for production of mass destructive weapons, cluster bombs, things like that. But it gets more and more sophisticated, more and more factors actually get included. So I do believe that this will be a major trend in asset management, and that everyone who provides products to the asset management industry will have to be able to factor in sustainability factors. And with that, I think I've gone through all my takeaways here anyway. My contact details are on here, and I'd probably, rather than reading these 3 out to you now, I'd probably just like to move over to a Q&A session and potentially answer any questions that you might have on top of what I've said. Thank you very much.